Good evening, everyone. Thank you for joining the USDOT Mid-South Atlantic Small Business Transportation Resource Center for our Nashville Bonded Education Program webinar. And this session will be on construction cost accounting. We're so happy to have you guys join us. It's been very, very informative so far. And also tonight we have one of our stakeholders joining us, Mr. Vince Malone from the Tennessee Department of Transportation. And also I'm going to call the roll. See how many let you know who all we have participating at the moment. And we have Carlo Hyde.
Here.
Daryl Jackson.
Here.
Emmanuel Tumbe.
Yeah, I'm here.
Phyllis Poole.
I'm here.
Roberto Zabala. Unmute yourself. Roberto.
Yes, ma'am. I'm here. Sorry.
Ruth, is it Kante?
Yes, Ruth Kante.
What company are you with, ma'am?
The CNF company?
Okay. And we have Terrace. Is it Swint?
Swint.
What company
Good
are you
evening.
with? What company are you with, sir?
Greenwood Oak, EITPS.
Oh, you're new. And we have Mr. Walter Portram.
Here.
And Miss Elaine Williams. Miss Elaine Williams, you're here.
I am. Good evening.
Nice to see you.
Thank you.
And that's who we all have. We have some people calling in. Could you
have Angelo Lowry also with 4K Construction.
Angelo Lowry, thank you. And someone else calling in? Another user? Well, okay. We're so glad to have you guys join us. We have our, we're gonna go over the homework review. The agenda is there. Welcome, the audit, I did the roll. Homework review. Then we'll go into the module with Ms. BIRIKTY, WELDESUS. Questions and answers, and then the survey. So at the moment, we'll go to the next slide. Here are our homework assignments from last session on February the 11th. These 5 items should be completed before you schedule. You can schedule your bonding one-on-one with me, but before you attend your bonding one-on-one with the ANC surety company. And number 1 was pull your personal credit report and review. Number 2 was rewrite your management bios. Number 3, compile your completed projects for the last 3 years. 4, interview a construction savvy CPA. 5, contact a bank to establish a line of credit. And number 6 is you're supposed to contact me to schedule your ANC surety bonding one-on-one session. Those sessions are going to be on March 3rd between 8 and 1 p.m. and March the 5th from 8 to 11 and then 1 to 2. March the 5th has most of those sessions are already booked, but we have a couple more. So please get with me to schedule your one-on-one bonding section. Okay, we have more people joining the class. We have Ms. Vontina Durham join. Vontina, you there? And I saw also that someone joined from a phone line. Yes, Ms. Jackson, Larita Jackson. So, okay, we're doing well. Right now we have 16 of our class online joining us for tonight's session. If you notice, when I sent the reminder email, I also attached the class contact list. You guys wanted that, we got that to you. And also had a flyer, but we'll discuss that later on. So, anyone else join? Someone's joining now that I did not call your name. May I ask?
Steger, plus Steger just joined. I couldn't get on the Zoom, so I'm joining by phone.
Okay, Mr. Cliff Steger, all right.
Yes.
And Miss Nikki is joining. So we have right now 17 of our class joining, almost a full class tonight. I'm so proud and happy that you guys joined. This will be a very informative session. And next slide. Ms. BIRIKTY WELDESUS will be the facilitator for tonight, and she's the president and accountant of the Fidelity Accounting and Tax Corporation. Next. Ms. BIRIKTY, would you please take over?
Sure. Hello, everyone. Welcome. So my name is BIRIKTY WELDESUS, and I have master's in accounting, over 17 years of expertise in accounting, mostly in manufacturing and entertainment industry. I served before I started my own business in January of 2013. Next slide. Okay, so pretty much this is my information. Our office is in Charlotte, North Carolina. And you got my email. If you have any questions, you can shoot me an email. Alrighty, so this is the contents. I know it's an accounting class, but we'll make it as fun. Maybe it would not be fun, but we'll make it not as boring as accounting should be. So the contents for tonight is all focuses, of course, in construction accounting. So we will have an overview of the construction accounting, accounting standards for construction accounting methods, accrual versus cash basis, percentage of completion method, completed contract method, unbilled receivables, billing in excess of costs, cost in excess of billing, over under billing, over billing. We've got a detail on that, under billing, and schedule of job in progress and revenue recognition. So it's heavily focused all on construction jobs. And if you have any questions at all, just stop me and ask questions. Next slide. Okay. So in this class, we'll learn all you need to know about construction accounting and job cost tracking for your projects from start to finish. So that means from, signing your contract to the end of your project. Next. Okay, so overview of GAAP, which is generally accepted accounting principles. The financial statement of a contractor should be based on the percentage of completion method of accounting for all long-term contracts, and disclosure should include a detailed financial statements, contracts, receivables, aging, breakout of contracts, like if it's ABC company or CBS company, the contract amount all broken down for each contracts. Retention receivables by contracts in progress, jobs completed, and any unbilled receivables. So your financial statements should include all of this for each project to be complete. Next. Okay, so earning for contracts schedule that reconciles the contracts in progress and contracts completed during the year to the income statement. Contract in progress schedule and completed contracts schedule that illustrates the contract revenues, cost, and gross profits by project for accounting period. Explanation of significant contract gross profit change. That means for each project gross profit. Retention accounts payable. Those are money you owe to your subcontractors, and contract backlog, which is from your list of contracts, what you have left at the end of the year. That's your backlog that you carry for the next period. Next. Okay, so what is ASC 606 in accounting? ASC stands for Accounting Standards Codification as defined by Financial Accounting Standards Board, or FASB. FASB's purpose is to establish best practice for GAAP, which is generally accepted accounting principles for accounting professionals and companies who follow those principles. In a nutshell, this topic covers the revenue from contracts with customers and identifies performance and licensing obligations. Next slide. Okay, so those are the steps for the accounting standard codification, revenue reporting for construction contracts. So those 5 steps. So identify the contract with a customer. This step outlines the criteria that must be met when establishing a contract with a customer to supply goods and services. And I'm sure you're all doing that, but we're just touching from the basic to the end. So that's the first step. The second is identify the performance obligations in the contract. This step describes how distinct performance obligations in a contract must be handled. And the third is determine the transaction price. This step outlines what must be considered when establishing the transaction price, which is the amount the business expects to receive from transferring the goods and services to the customer. Number 4 is allocate the transaction price. This step outlines guidelines for allocating the transaction price across the contract, separate performance obligations, and is what the customer agrees to pay for the goods and services. And the last one is recognize revenue when satisfies a performance obligations. So those steps, I'm sure you're doing it again, but you sign your contract, and the contract would have a detail like material, whatever. So depending on your industry or in your field of expertise, you outline a detail in your contract, including the price. Next. Okay, so what is revenue recognition? Revenue recognition or income recognition is how a contractor determines when they have officially made money on a project. It also helps determine when they should officially record an expense. Remember, this comes into play because construction contracts are usually long-term and often have delayed payments. Contractors aren't necessarily able to complete, bill, and collect on a contract in the same month. In fact, for many contractors, it just never happens. That leaves contractors and construction accountants with a choice of revenue recognition method. The method they choose will determine when income and expenses count. In some cases, they might use one method for bookkeeping purposes and another method for tax reporting, as long as they remain consistent over time. In construction accounting, the main options have traditionally been cash basis, completed contract, and percentage of completion. So those are the options they use. Any questions or clarification you need on this? Next slide. Okay, so the revenue recognition method, the simplest method for recognizing revenue is the cash method. Everything is based on the real-time impact on the company's cash. Contractors record revenue on only when they receive the payment, and report expenses when only they actually pay. Therefore, there are no payables or accounts receivable under cash accounting. If money didn't change hands yet, there is no transaction to account for. While cash basis accounting has several advantages, it is not for every construction business. In fact, while many small businesses prefer cash accounting for its simplicity and flexibility, only some contractors qualify. According to the IRS, only construction businesses with less than a set average annual revenue, and we'll cover that, the amount on a later slide, can use the cash method for tax purposes. If business sales exceeds that amount, they will have to use accrual method for tax purposes. In that case, they may decide simply to use accrual method for their own books as well. Accrual method will recognize an expense when it is incurred and revenue when it is earned, even if cash hasn't come in or out yet. In other words, it tracks how money accrues or accumulates in holding before it moves as cash. You need any clarification on this one?
All right, take off your dress, take off everything, get ready for pajamas.
I had a
Okay.
question. I had a question regarding,
Sure.
I don't know if this is time, but when we're talking about accrual versus cash,
Uh-huh.
is there any advantages that would make you use one versus the other?
Yes. Like I said, cash basis is basically you report, and we'll cover more on the later slides. But so with cash basis, it's advantageous for you to use that for tax purposes. So when you do your income tax return, if you are cash basis, you don't count your invoices that has not been collected yet. If you didn't collect the money, you don't count it as income. So that means, let's say, if you have $500,000 in total income, but let's say 200,000 is in your receivables. So if you are on cash basis, you will only report. See, if you have 500,000, the 200,000 you don't report it for your taxes. It will be the 300,000. So that means you're paying less. So you with me? So the receivables portion, it's not counted as an income because you are cash basis. You haven't collected your cash, so it's not reported at the end of the year.
And you mentioned that once you get to a cash or a accrual basis, you have to be consistent with it. Is it allowed to rotate depending on your income situation or revenue situation?
So you mean your accounting method. So every company should keep an accrual basis, but you can still, for book purposes, you have to keep it on accrual basis because you have to invoice your clients. So you will have receivables, you will have invoices to pay, that is your payables. But for tax purposes, you always have to be consistent. You have to use your method that you use in cash basis. And if you're accrual basis, of course, you have to continue using accrual basis, but you are allowed to change with IRS. Once you can change it without notifying them, but you do have to take permission, I guess, from them to change from accrual. You can't just go 1 year account accrual basis, the next year cash basis. If you are cash basis, you remain cash basis. You're allowed to change it. Like if your first year use cash basis and you realize, no, that's not going to work for you. You are new in business. The next year you go to accrual basis and you stick with it, but you can't keep changing back and forth from accrual basis to cash basis.
Thank you. And that is unless you get permission from IRS.
Exactly, yes. Did I answer your question?
Very good. Yes.
Okay, great. Next slide. Next, sorry. Okay, so here's the accrual method that we were just talking about. This income tax method of accounting reports income from construction contracts as progress billings are made and deducts expenses as job costs are incurred. So that is exactly what we were talking about. So you report as an income as soon as you bill them. It could be $100,000 this month, or and that's it for that month. That is included as revenue. If it was cash basis, then it wouldn't count until you receive that money. And also for the expenses the same way. Using the accrual method of accounting may result in a situation where the contractor is able to show significant income for financial statement purposes while minimizing tax income. Taxable income will increase when a contractor is overbilled on a job, and taxable income will decrease when a contractor is underbilled on a job. And we'll go in detail on this on later slides. Accrual revenue is recognized when it is earned or received, and expenses are deducted when the expenses occurs, not when cash is paid. Accrual electing to exclude retainage. Accrual basis contractor can exclude retainage receivables and payables. So your retainage is not a regular receivable. You can't invoice it until they approve it. It's final, then you invoice it. So that is why the retainage receivables can be excluded, even if you're accrual basis.
And so that means because retainage, you don't necessarily, it's not necessarily guaranteed that you're going to get it, correct?
Yeah,
Because
and
of
yeah,
what your
exactly. And you
last
go ahead.
inspection. Because of your last inspections, you don't know whether they're going to take some or out of your retainage or not.
Yeah, that's right. And that is the last. So until it's approved, really, you can't even invoice it. So you finish the project, you have the retainage, it is on your receivables, but you can't receive it until they walk through, approve it, you've done the work, and that is when you can get your money. So that's why you can exclude that, and even if you're in an accrual base. We good?
Thank you. Very good.
Okay. Completed contract revenue and costs incurred on a contract are not recognized until the contract is completed and accepted. So that's the completed contract. Example of cash basis and accrual basis income statement on the next slide. So we're going to see it on the next one. Next. Okay, so this is an example of accrual basis income statement. So if you see your job income here, you have 775,000 dollars, and then we'll go over description of changing over and under bill and how it affects your bottom line. So here you have net income or loss, which is a loss in this case, 123,637 loss. So now we're going to go to the cash basis income statement with the same expenses. Next slide. Okay, so here's your cash basis income. So your job income here, it changed 575,000 because you have that 200,000 in invoices that is not collected yet. It's sitting on your accounts receivable. So here your net loss increased by 200,000. So now you have 323,637. So that is the effect of cash basis versus the accrual basis. So if you were accrual basis, you would have, by that much less. Okay, next slide. Okay, so we have questions here for everyone. When should a contractor put revenue on their income statement? When they finish each phase of the project they are billing for, or when the project is complete, or after the check is in the bank? That's question number one.
And accrual when the task is complete and the check and when the task is complete, work is complete.
Can you repeat that one more time, please?
When the phase of project is complete in the accrual basis.
Okay, so you're right. So did you say, if I understand you correctly, did you say when the project is complete?
When the phase of the project is complete, the first one.
Okay, yeah, that is correct. So the project could go a long way, So if it takes a year to finish the project, you would want to invoice them, as the phase, if you take 10%, then invoice them for that. So that is correct. You're good. So what is cash basis accounting method? Would a contractor benefit from this method?
Yes.
That is true. We just went through it. So yeah, the benefit is because you're not paying taxes on the amount that you haven't received yet. So that is sitting until you collect it. So yeah, you would definitely benefit from cash basis method. And the difference between accrual and cash method. We're repeating this stuff because it's very important in construction.
Well, it's accrual is when you accrued it, and cash basis is when when the money transaction was made.
Happens, correct. That is very correct. That's right. Okay, how does job costing estimate help construction companies?
It helps you with your bottom line pricing on what you're charging and what you should get at the end of the project.
That is correct. Yes, because without that, you have to estimate how, when you take a project, you have to estimate how long it would take you, how much it would cost you to finish, and how long it would take you. So you have to estimate your labor, your material, if you need any equipments for that matter. So definitely that would help. Without that, you wouldn't you wouldn't know if you're going to make money or not. Okay. What would be best practice for contractors to use a percentage completion method or completed contract method? Actually, this one we haven't gone through it yet, but you can try.
I would say the percentage of completion.
That is correct.
Because
Go ahead.
because you're getting it as you complete your project instead of when the contract is complete.
Exactly. Yeah. Completed contract method, number one, it would take you longer to invoice. So you were going to go without income for a long time. So you will have cash flow problems. So definitely percentage of completion. Thank you. Good. Next slide. Okay, so decentralized jobs. So projects work primarily happens on different job sites rather than fixed locations. So both equipment use and labor then frequently move from site to site. This can result in mobilization cost. It also means that equipments and labor costs always have to be tracked to each job site with correct job rate or wage rate. So this is always a problem in construction, because if they use one person in two different projects in the same day, and so you have to, if you want to accurately measure how much you spend on that particular job, then you have to have, like, I don't know, project manager, whoever, tracking how many hours that person had spent on each project. In the end, construction companies have one way to control costs and bid intelligently. That is to track accurate costs for each project individually, as well as the types of expenses and production activities that make up the job cost. Next. Okay, so this is specialized construction billing. So construction production is project-based, decentralized, and long-term contractors may use a number of billing styles and methods. Often that requires specialized software to track and create those billings. Okay, so let's look at this few types of billing formats. So fixed price, also known as a lump sum contract. Fixed price billing is based on detailed estimate, gives that total cost. Okay, that's my math. Total cost for the entire project. It can also be considered in two types: fixed price, which is hard bid, and fixed price negotiated. I'm sure you all guys are familiar with those terms. So a hard bid essentially says, no matter what, we are building it for this amount of money. So it's so you just say whatever it takes, we're going to finish it. This, so you give them a fixed amount of money bid for that project. As a result, the risk is heavily on you, the contractors. So if there is any overruns because of changed sites, conditions, or input costs, that falls on the contractor. And negotiated lump sum, on the other hand, might allow for some contingencies and unforeseen events. Billing a fixed price contract often happens on a percentage of completion basis with retainage withheld. Now, time and material. So time and material billing basis, the contract price on a per hour rate plus the cost of material used. For both the labor and material components, the contractor may apply a standard markup. This builds their profit percentage into the amount and accounts for the cost of overhead. Next slide. Okay, so unit price. Under unit price contract, the contractor bills a customer at a fixed price per unit rate. Typically, this will be useful if they aren't able to estimate the unit production for the project with a lot of certainty. Unit price bill is especially common among heavy highway and utility construction companies. With unit price, risk tends to be shared between contractor and customer, since production quantities can end up higher than estimated. As long as they have estimated the unit price correctly, the contractor may increase their revenue in this case. Otherwise, if unit pricing is off, then they may lose money. One common construction billing format is known as AIA, progress billing. I'm sure you guys are familiar with this one too. So the name came from after the American Institute of Architects that produces its official forms as a type of progress billing. AIA billing invoice the customer based on the percentage of work completed for that billing period. This invoice generally consists of a signed summary sheet followed by a schedule of values that details what has been completed and billed to date. These documents are considered an application for payment because the recipient will have a chance to review the schedule of values and either accept or dispute the billing amount. If they disagree, they will send it back red line so that the contractor can revise and resubmit the AIA billing application. Next slide. So this is an example of that billing. So basically this is their invoice. So sample here, original invoice shows 97,500. They had a change order 2,500. So contract sum total is 100,000. So completed 25,000. So the retainage is 10%, which is 2,500. So total earned less retainage is 22,500. So that is basically the invoice amount. And then it shows the balance at the end, balance to finish, and then percentage completed. Next.
I have a question.
Sure.
Yeah, so on the time and material, you mentioned that, you can mark up the labor and the materials. But when you mark up, you said the profit is that part of the markup. So do you just mark up your labor, the overhead, and then you add on your profit? Or is the overhead has to include also the profit?
Okay, yeah. So when you calculate your markup, yes, of course, you have to include your overhead. So let's say your material cost for that particular 100,000 project. If you estimated material will cost me $50,000, labor $40,000. Well, actually, well, you can reduce that to 20,000. So you have $70,000 cost, right? You with me?
Yes. And that $70,000 is the direct cost without any overhead, without any profit.
That is correct. So that's why you mark up. And it's always a good idea to know your overhead. So you have to calculate your overhead with, your insurance, rent. So you take this total and you get your percentage overhead. You can do that, divide by total sales, and that would give you your percentage. So that would be your overhead. You can mark that up. You can add to your overhead 10%, 15%. That would be a markup.
Okay. Yeah. So you take your overhead and then you add on your profit. That's the total markup, right?
Yes. So what industry are you in?
Right now, I'm mostly into engineering, but I'm getting into construction. So yeah, we have a contractor license and we want to start doing construction.
Okay. Yep. So yeah, different industry has different type of expenses, I should say, or different structure of cost. Now, if you are in engineering, you can definitely do your markup and use your overhead rate and your actual cost, and that would give you an estimate. And you can tell what profit you're going to make. So your markup should be actually your profit.
Okay. Thank you.
Welcome. Okay, so this second page of that AIA is, it shows them the description, scheduled value, and then what you completed for that period, and then your percentage completed, and your retainage. So that's detail for them. Anyone has any questions on this form? Does anyone use this form as of now?
No.
No? Okay. Next.
Yes, I do.
Oh, okay. Okay. So, all right. So we're going to change orders. It is important to manage change order. Significant financial problems may occur if the change orders on a project get out of hand. To best manage your construction company, use the work in progress schedule to keep track of exactly where you stand with regard to progress on a project. The project cost, both the actual costs that have been spent so far, as well as rigorous calculated estimation of the total costs required to complete the project, and exactly how much of this cost remain. With this information, the company can get accurate measure of the percentage of completion. And by looking at your billing, you should be able to see if they are under or overbilled, and by how much. Knowing all of this financial information is imperative for construction companies. So yeah, so change orders immediately, as soon as it's approved, it has to be included into that project, added into that project amount. Next.
I wanted to just kind of talk about a little bit about the change orders, and I know this may be on the legal side, but a lot of times you may get on a job and if you're working under a prime contractor, they may ask you to do some things that may require you as either as a prime contractor on that side there, or on the subcontractor side, do something contractually. What is the to enforce a change order, because you got a lot of word of mouth? What should you do to make sure that there's no misguidance or misunderstanding after in order to proceed on a change order?
So in order to avoid any misunderstanding, all change orders should be signed by the project manager. So you should have a signed detailed statement of the change order and the amount, and it has to be approved. And you will have the signed approved paperwork from the project manager or the owner. So am I answering your question? Is that what was, I think I'm missing something.
Yeah, that answer, that was my question, that at minimum, what should you have before proceeding, before you do a change order? And you answered the question that you need a signed approval from the customer or the prime contractor, whoever you're working for before you proceed.
That is correct. Yes. So you may originally you may agree for that project that you don't, you be okay to finish this, but then you say, oh, I need a change order. I'm going to need more money is basically what he's saying to finish. I still have more work to do. And most of the time the project managers, they know. So then they'll give you the approval. Okay, this is how much it's going to be. Okay. So yeah, you need your signed change order. And
Yeah.
immediately, go ahead.
Yeah, thank you, because that's one thing that I was just thinking, you got to have something to really hold your whoever it is, otherwise there's potential for confusion.
Yes, and it would create problem as well. So you may not get paid after you do the jobs if it's not approved. So definitely it has to be approved, and immediately after you got the approval, add that change order to your contract. So now if you start at 100,000, you have a change order of 25,000. And if you forgot to add that, you are underestimating, which affects your financial statement. So you have to add immediately to the total contract. So now you have 125,000 instead of original 100,000.
Thank you.
Thank you. Next. Next slide. Oh, okay, sorry. Okay, contract retainage. So another peculiarity to be accounted for in construction is the practice of withholding retainage or retention. Retainage is the predetermined amount of money an owner may hold back from payment until they are satisfied with the contract completion. A common retention amount, normally it's between 5 to 10% of the contract value or invoiced amount, but it can be less or more. The idea of retention is to provide the customer with some security against any deficiencies or defects on the project. Next slide. Okay. So how retainage works. For most contractors, retainage is simple enough on a paper, even though by nature it is an exception to the rule. In practice, when contractor earns revenue under accrual method like contract completion method or the percentage completed method, they have the right to issue an invoice and record the amount as an accounts receivable until it is collected. It is this is except for retainage. According to revenue standards, the contractor doesn't have a current unconditional right to the retainage portion of an invoice. Therefore, it is not treated as a receivable. As accounts receivable amount. Contractors record it instead in a separate asset account. Once a contractor does have a right to it, after satisfactory contract completion, the contractor issues an invoice for it and moves it from the asset account to the accounts receivable for collection. Retainage laws vary from state to state, but in some cases, owners can withhold it for over a year. Additional retention between 5 to 10% can actually take a 20 to 50% bite out of contractors' profit. Given construction's narrow profit margin, the smart retainage management is at least as important as a proper retainage tracking. Okay, so estimated cost to complete. Construction contractor financial statements rely heavily on estimates. On this, one thing that is critical to the contractor is estimated cost to complete on contracts. Accurately determine the estimated cost to complete is very crucial. So cost estimates include material cost, labor cost, equipment rental, and subcontractors cost. So when you do your estimates, those are the things you need to consider. Okay, depreciation. Another estimate that is important for contractors that have equipment intensive business, such as heavy highway contractors, is depreciation. If the equipment's useful life is not correct, the contractor could be charging an excessive amount of expense to a project, which would have a negative impact on profitability. Most often than not, contractors are incorrectly using the same depreciable lives and methods of financial statement and income tax reporting. In doing so, a contractor may significantly understating equity by using an accelerated tax method for financial statement reporting. This can have significant impact on bonding and banking program. So this I throw it in there just in case if there's any, but this would be more, like I said, heavy highway, people who use heavy equipments. Not all construction people use that. Okay, so contractors recognize revenue differently. So that's true. We discussed earlier. We're gonna repeat it now. Suppliers and service providers recognize their revenue as soon as the sale is made. Contractors, however, have a more complicated revenue stream. Many projects last several months or even years. Contractors have two choices: recognize the income at the end of the project, or recognize it as the project progresses. Waiting until the end of a project makes the accounting easier, but means that a contractor's income will seem unsteady or irregular since projects end at different times. A contractor may go a month or two with no projects ending, meaning they essentially have no income to report. Recognizing income as a project progresses, known as a percentage of completion, is the best option for long-term contracts. Next slide. Next. Okay. The percentage of completion method allows a contractor to recognize revenue as they earn it over time. As a project progresses toward completion, the contractor can bill for the work they have performed. Each time they issue an invoice, they can record the earned revenue. This continues until they finish the contract. Next. Okay, completed contract method. Completed contract method, this method only recognizes revenue and cost of projects once they are completed. Completed contract method is usually used in a residential sector and on small projects of short duration. The IRS requires contractors to use percentage of completion for long-term construction projects. The only exception are for home construction and small contractors. The small contractor extract exception depends on two conditions: the size of the project and the size of the contractor. Next. Okay, so under the completed contract method, contract income isn't reported until the project finishes. Neither are expenses. Of course, that doesn't mean there aren't expenses during construction or that contractors can't bill in the meantime. It just means that only profit, any profit isn't official until the end. Everything hits the income at one time. This sometimes means contractors are able to defer taxable revenue if the contract won't be completed until the following tax year. Completed contract method also has particular restrictions from the IRS. To be eligible, contractors cannot exceed a certain average annual revenue, and their contracts must be able to be completed within a set time frame. A contract is considered complete when it's at least 95% of the contract costs have been incurred and customer has used use of the property. The contractor then must report the remaining total contract revenue in the year the contract is deemed for IRS purposes to be complete and account for all remaining costs in subsequent years under its overall method of accounting.
I have a question. Does your expenses flow the same way as your revenue when you're trying to recognize your expenses? Depending on your accounting method?
Can you repeat that one more time, please?
I know we're talking about recognizing income for the IRS. Does recognizing your expenses flow the same way as recognizing the income?
Okay, so so let's talk about what cash basis.
Yes, cash basis versus the accrual basis.
Okay, so on cash basis, you account your expenses as soon as you pay it. If you write your check today, that is, you paid it, that is an expense accounted for.
And accrual basis is just like with the income, once you accrue that expense, that's when it, even though you don't pay it, if you were billed for it, but haven't paid it yet, then, the moment you're billed for it is the moment it's accounts payable.
And that is correct. That is correct. So on accrual basis, if you have like 100,000 expenses in accounts payable, you haven't paid it yet, but it is accounted as expenses. But in cash basis, you don't count what is in accounts payable, or you don't count what is in accounts receivable. You with me?
Yes, for sure. Now, one more question, I'm done. Yeah. Now, when you're reporting, when you're doing your taxes, do you have an option, or does your expenses and your income have to flow? If you're going cash basis, it's cash basis, or your income and your expenses. If you're going to do accrual basis, it's accrual basis for both your income and expenses. They both have to flow the same way when you report. You can't do your expenses on a cash basis and then do your income on a accrual basis.
That is correct. So if your accrual basis, for accounting purposes, you select that says accrual basis, then your revenue and your expenses is in that method. That is accrual basis method. You with me?
Yes, great.
So you can have accrual basis for your book purposes, to keep your books as such. Like if bank asks or your insurance asks for a report, they're not going to ask for cash basis. Normally, they will ask you for accrual basis. That shows them how the company is doing total. If you have so much income, it shows them what you invoice versus cash basis doesn't show. Cash basis, in January, you can have $1 million because you have just collected from prior year, all those people paid right in January of 2021. You know what I'm saying? So your cash basis doesn't show the whole picture that they wanted to see, how the business is doing. So mostly you want to keep your books on a accrual basis, and then you will have a cash basis for your tax purposes.
Thank you.
Confusing?
No, no, very, very good, very clear.
Yeah, we can go one more time over it if you want.
No, no, I think you did a good job of explaining that.
Oh,
Very
okay.
good.
Okay, thank you. Next slide. Okay. So the IRS defines the small contracts as those that will be completed within 2 years. It defines the small contractors as those with gross receipt not over 25 million in previous 3 years. So both of those conditions must be met to use the completed contract method. Generally accepted accounting principles requires the revenue to be recognized in the period it was earned. This means for most long-term projects, the percentage of completion method should be used. Okay. Okay, so unbilled receivables. So unbilled receivables are amount of money that have been invoiced to your client that have not been invoiced to your client even after construction is completed. When unbilled receivables occur, it is because they cannot bill yet under the terms of a contract. Unbilled receivables, also termed as deferred revenue, are marked as an asset in your balance sheet. So I put an example of unbilled revenue. So if you have unbilled revenue of 25,000, you and you defer that revenue, deferred revenue, you credit that. So those are both balance sheet accounts. Okay. Any question on this one? Okay, next. Next slide. Okay. Did you skip one? Okay. Okay, I thought so. Overbilling occurs when a contractor bills for contracted labor and materials prior to that work actually being completed. For example, during a billing cycle, a contractor completes 20% of a project, but bills their customer for 30%. That extra 10% is an overbilling, is the overbilling amount. Some companies overbill to help offset the negative impact on the cash flow caused by slow paying customers, unfortunately a common occurrence in the construction industry. One of the most significant area many construction companies need to improve is to simply do their accounting faster while making sure to record all of the cost and revenues in the correct accounting period. Don't wait to send your invoices and don't let day-to-day accounting tasks get out of hand. Okay. Next. Okay. Underbilling is the opposite of overbilling and occur when a contractor completes a certain amount of work during a billing cycle on a project, but does not bill their customer for the entire amount of work completed during the cycle. For example, if the contractor completes 30% of the project during a billing cycle, but submits a progress bill to their customer for just 20% of the overall contract value, the contractor has underbilled by 10%. So Just to give you an idea of over under billing, it's very confusing in calculation, but it gives you an idea. Next slide. Okay, so the calculation of work completed. Total cost to date divided by the total estimated cost will give you that percentage of completion. For example, a project that has estimated cost of $300,000 has incurred $150,000 in cost so far. So if you divide the cost into a total of the cost into a total estimated cost of 150,000, that give you 50% completion. So 150,000 divided by 300,000, 50%. This means half of the total revenue of the project can be recognized. If the contract is for 120,000, 60,000 can be included in income statement. The calculation above seems pretty simple, but when change orders are included and estimates change as the project goes along, the calculation can become fairly complicated. The work in progress report provides a summary of information using the percentage of completion calculation. It includes total revised contract amount, total cost to date, percent complete based on cost, amount billed to date, and the difference between the amount billed and the percent of revenue that can be recognized. Kind of confusing. Next, I have some slides that I can explain more. When the amount billed to date is more than the revenue that is recognized by the percentage of completion method, that is called overbilling. Because of the contractor has billed more than they should, the overbilling is recorded as liability on the financial statement. If the amount billed to date is less than the revenue that is recognized by the percentage of completion method, that is called underbilling. That amount is recorded as an asset as more money is due than has been billed. The differences in the billing amount are recorded as a journal entry in the general ledger. They increase or decrease the amount of revenue recognized on the income statement and create an asset or liability on the balance sheet. These adjustments ensure that the income shown on the income statement is reflective of the percentage of completion method. Next. Okay.
Could I ask a question? When are those statements made? At the end of the year or continually throughout the year?
It depends on a company. So if you are a smaller company, you can do it at the end of the year versus a large company, they have to do it on a regular basis. You know, if you have so many projects. But as long as you keep your estimated per project, for each project, if you have your estimated cost, and then it will show your actual cost, and then it will show you the difference where you're at. So as you go every month, at the end of the month, you include all your invoices, make sure you get all your expenses in, you know, making sure by the end of the month, you get all your invoices for your materials, everything, your labor, payroll. And so if you have correctly entered in the system, you can track it. It can tell you every month. So, oh, I'm getting close. So I'm making money now, or I have this much left, but I'm already losing money. So what do I need to do? So it's, you can keep up with it even as a small company. Every month it would tell you. You don't have to calculate the schedule of jobs like I did here to see overbilled, underbilled, but you should keep track your estimates versus your actual cost that is happening every month. that you should know every month where you stand in a project. But as far as calculating your over under billing, if you're a small company, you can you can do it at the end of the year. You still be okay, but you still have to track your cost, where you stand in the project. Are you making money, losing money? If you are 50% done this month and you're already losing money, then yeah, you should track all your project on a monthly basis. Okay. Any questions? Did I answer your question?
Yes, that's good. Thank you.
Okay. Was I harsh? I was harsh. Can you go
No, that's
back?
good.
Okay. Okay, back to the other one. The prior slide, please. Okay. So this schedule of job in progress is a sample I did for you to show you, so you can see your contract amount. So what you have done, build to date shows 25,000 for the first one, Happy Construction, and then cost of revenue, so 25,000. So that is your actual cost. That's how much you spent. And then you have your estimated cost. So the cost estimation, so if you are new, you know, you don't have that accumulated history to see that. But if you started early doing your estimate on this cost, so that is when you plug in, okay, this is what I'm estimating to cost me. So you do that, and then it helps you when you do your actual cost. You know, if you do less, then you're doing really good. So this is what we estimated, but you know, maybe labor was good. Maybe the project manager is doing good on facilitating the project to get it done faster. So you can see on your, the other thing you can do if you are new on estimating to give you an idea, you can take your cost of goods sold, you divide that by your total income, and that will give you a percentage. So that is the percentage of cost. So let's say if you have $100,000 on job revenue, okay, and your cost of goods is, you know, your labor, your material, your equipment, as we said earlier. And so total those, if you have 50,000 or 80,000, that's unreal for construction. So you divide that, so you have by 100,000. Yeah, close to 20%, no, 80%. So I'm doing that right now. So if you don't have a set, you can set your estimate on your accounting. So let's say 80,000 is your cost of goods sold, and you divide that. We said 100,000 is your total income. So yeah, 80%. 80% would be your estimated cost. So you can multiply that, let's say, by that. So it would give you estimated cost $80,000. You with me? Are you following?
Yes.
It's too much, I understand, but I just wanted to give you an idea, so when your accountant does it, it's better for you to understand it. But so that's the estimated cost. So either you have your own estimation from history, or like I said, you can use the cost of goods sold to sales revenue to get an estimated percentage, and you multiply that by the contract amount to give you your estimated cost to complete for that project. So that's one thing. Okay, so but anyway, so this gives you an idea, so you can see the gross profit to date is 0 so far because you built 25,000 and you already spent 25,000, so you don't have profit on that. And then it shows your percentage of completion, and here is your under overbilling. So again, this is to just give you an idea. But for a small company, you can do this at the end of the year, the over under estimation. So this would affect directly your income statement. So at the bottom, you see that 421,000 that shows overbilling. That would affect your income statement. So definitely you do this at the end of the year if you are small, but definitely keep track of your projects, doing your actual costs and your estimate for each project accurately every month and see where you stand.
Very good. Thank you.
Thank you. Next slide. Okay, yeah, so based on that sample I did earlier, so you have, this is an asset account, cost in excess of billing, you had 8,333, and then you have billing in excess of cost for 123,370, and then the over under billing that directly goes to your income statement is 421,000. So just to give you an idea, that's a journal entry that you have to do after that calculation is made. Okay, next slide. Okay, so this is the balance sheet to show you an example. Okay, so that's your bank account. So your accounts receivable, you have 20,000 sitting there, and I wanted to show you the yes, accounts payable. So this is billing in excess of cost. Yeah, right here on your balance sheet. Okay, next slide. Next. Okay. Job costing. For most businesses, the accounting general ledger is all you need. This lets you track transactions that impact the whole company's financial picture. However, because construction accounting is project centered and production is decentralized, contractors also need a way to track and report transactions specific to each project. That is the job costing. So that's what we talked about earlier, how decentralized construction could be. You know, you have projects in different places and you can send your equipments here and the same person working at 2 different jobs, and you have to identify how many hours that person worked on this project and that project and allocate that accurately so you know which project is costing you, you know, how much. So, and that also helps you on your future. So all this estimation and job tracking, in the long run, it helps the company to bid better. So you know from what you're doing, how much it's costing you. So you know a similar project, how to bid better because you already know what you have, how much it's costing you. Job costing is the practice in construction accounting for tracking costs to particular projects and production activities. And next slide. Okay, what job cost does. So your general ledger, it tracks your company financials. It produces financial statements, your accounts receivable and accounts payable, agent report, over under billing, it organizes by charts, a chart of accounts. And then the job cost side, it tracks your project data, which is each project by project amount. it produces estimated versus actual in your production report and work in progress reports, and it organizes by job structure. So within that accounting system, you have this too. Any questions on this? Okay, next page. Okay, so billing and access So billing and access is a financial term used in construction industry to refer to the dollar value charged to customers in excess of cost and profit earned to date. Many contractors bill customers before the job is completed to cover cost. Billing in excess is the amount contractors owes to a customer for what is left to complete on a project. When underbilled, billings in excess is work that is already completed but not yet billed. When overbilled, billing in excess also refers to work that has not been completed but for which an invoice was already sent to the client. Billings in excess is always used with the percentage of completion accounting method. This method transfers value to the income statement and costs as the contract proceeds throughout its timeline. Next. Okay, so this is revenue recognition doesn't equal payment. So this is mostly, knowledge to your accounting needs. Most commercial contractors, both general contractors and subcontractors, use the percentage of completion method to report their income. When most of your projects last at least a few months, it is most accurate way to recognize revenue. Of course, reporting income means nothing if you are not collecting payments. Cash can only flow out of your business if it is also flowing in, regardless of accounting method your construction business is using. It is important to take steps to secure your payment on every project. Using percentage of completion, income recognition requires some specific data that can be difficult to gather if you aren't using construction accounting software. If your company is looking to transition to a percentage of completion revenue recognition, consider changing to a software package that supports it. It will save you money over the long haul. Next. Okay, mistakes to avoid when using percentage of completion. Because income recognition is based on a percent of the revised contract for each project, it is imperative that change orders are entered into the system as soon as they are approved. If work has been added to a project and not been entered into the accounting software, the project may appear to be overbilled based on the percentage of cost. We've talked about this one earlier. So if the change order is not added, it's going to appear as if it's overbilled because it's not showing the total amount. Making sure contract amounts and estimates are accurate on the work in progress report ensures income is reported correctly. Overbilling a project to increase cash flow reduces the amount of income the company records for that period. Next. Okay, income will be reduced by the amount of overbilling. If a company consistently overbills, they will have trouble covering costs as the projects are completed. There won't be enough left in a contract balance to cover the cost at the end of the project. The best bet is to build the correct percentage of completion and look at other ways to improve cash flow. Underbilling projects isn't a good practice either. Reducing the amount billed means you may not be able to cover expenses for the period, causing cash flow problems. The best practice is to bill at the correct percentage of completion. Next. Okay, so this is the IRS definition of a long-term contract. Contract exempt from IRS Section 460 provides two exceptions for long-term construction contracts to the required use of percentage of completion rules and the application of look-back. Any home construction contract is defined under the section IRS Section 460. Under that Section 460, percentage of completion method of accounting is required for large contractors with contracts meeting the definition of a long-term. The long-term contract are defined as the contracts that are not completed within the same taxable year in which it is entered into. Additionally, the contract has to be classified as building, installation, construction, or manufacturing contract. Next. Next. Okay, so skipped one. Okay, thank you. Okay, so the contractor exception requirements, the following two requirements need to be met for the small contractor exception to apply. At the time the contract was entered into, it was estimated that the contract would be completed within a 2-year period, beginning on the commencement date of the contract, and the contractor's average annual gross receipts for the 3 taxable years preceding the year in which the contract was entered does not exceed 25 million. Average annual gross receipts are measured on the revenue reported for income tax purposes. Therefore, it is necessary to apply proper tax reporting to exempt and non-exempt under the IRS 460 contractors, so as not to inadvertently overstate your gross receipts. The 3 years is looked as on a current and ongoing forward basis. Okay. Next. This is basically just the rules. Exceptions and elections. So this code section can be complicated with many exemptions and election involved. For example, service contracts are exempt from the provision of 460, the IRS Section 460, including but not limited to architects, engineers, construction managers, and other commercial painters. Home construction contracts with 80% or more of the estimated total contract cost expected to be attributed to a home construction contract are exempt from Section 460. Those projects must be related to construction of dwelling units containing 4 or fewer units. Small contract exemptions, you are exempt from following 460, Section 460 when accounting for your long-term contract, meaning no percentage completion method. A small contractor is a contractor whose average annual gross receipts for the 3 taxable years preceding does not exceed $10 million. One word of caution, make sure you know if you are part of the controlled group or you will become part of the control group. So this may not apply to you. I just thought I include that, so I didn't know my audience, so they information is general. Next, you may benefit from it or you may not. Okay, so these are homeworks. Do you have questions so far? Do you need to discuss? Do you want me to touch any other subjects that you may have?
I have a question.
Go ahead.
Do you know of or recommend an accounting system for contractors that would be able to capture
Definitely.
all of that information and display it in a manner that you could readily see it?
Yes. So depending how large your company is, you can use, if you are a small company, you can use actually QuickBooks for construction. I think it costs like $1,000, something like that, but it's better. So it has, you can track your projects by project. You can enter your estimates and actual cost. So yeah, definitely. So like I said, if you're a smaller company, you can use QuickBooks for construction. There's different version. So that's friendly. If you are on a larger scale that you need a lot, you can use Foundation. It's a very expensive software, but if you are large, I would rather use that. So so Foundation has the job tracking. Also, if you have payroll, they have, you know, if you need to report wages to the government, it has the prevailing wages, all of that was in that system. So that is another one. If you are large enough, you can use that because it's expensive.
Very good. Thank you.
Of course, welcome. Any other questions?
I have a question, and it's dealing with, I don't know if this is a accounting attorney or not, but when you're talking about being taxed in construction, we got, if you are LLC being taxed as a partnership versus a corporation like an S Corp, is there any reasoning why you would do one versus the other?
So you said you're a partnership?
LLC, limited liability company.
Yeah,
And
partnership LLC is what you said.
And if you were to want to be taxed as, if you're currently being, let's say you were currently being taxed as a partnership at the end, you got the option to be taxed as a S Corp if you're LLC. Is there any reason why you would, any advantages one versus the other, or what, you know, the advantages one versus the other for tax purposes?
So, so if you are partnership LLC, so you are reported as cash basis, and depending on your partnership, 50-50, 20-80, however it is, I don't see any disadvantage. So if you are, you can still be S corporation partnership. You can form your company as S corporation and be a partnership. That probably would be better for you versus being an LLC. So the S corporation would let you be still partners. That's one. And number two, it would be you are partners, but at the same, you are employees of the company. Versus just LLC partners, you are, you know, liability wise, you guys are personally responsible for everything. You know what I mean? So the S corporation would be good. You can still be cash basis, and you can still do similar things that you're doing as an LLC, except you are a corporation and you are not part of the company. You owners, but you still, the company is independent, if you with me. So right now you're doing a partnership 1065.
Yes.
Yeah. So I would do S corporation. So you were asking the difference, right, between S corporation and LLC, what would benefit? which would be
What
more
the
beneficial.
benefit- There one benefit, one versus the other, or what's the benefit, or why would one choose one over the other?
Oh, okay. So, so like I said again, number one is that the company is separate from you when it's an S corporation. And number two, you can be, like I said, employees. So as a partners, are you taking, you said you're LLC, are you taking wages?
Yes, taking draws.
Yeah. So if you were S corporation, like I said, you would have been employee. You can still take draws. It's called distribution, but you can take wages. With partnership, you can also do, it's called guarantee payments. You can still do that, but like I said, if you are S corporation, you can do wages because you are employee of the company. I didn't answer your question.
Thank you.
Did I answer your question? Do you
Yeah,
need me to
that
explain?
pretty much answered. And I'm gonna look at, I think there's a certain time that you get to make that change to before at the beginning of the year. And then after that, you can't. So thank you.
Yeah. So yeah, if you need to change it, yeah, I would change it before the end of the year. So effective January 1st, you will be a different entity. So yeah, that's the only thing, like I said, was LLC. You are responsible as partners. But if you separate yourself from the company, that is one of the advantages. You know, like I said, you can still take distribution, but you can take W-2 wages as well. Okay. Anyone else has any questions on the estimate? So you guys have to be really focused on your, we didn't touch the other part of accounting because our more condensed all around project. So, and that's basically what you need. So your focus will be on your contracts and your estimates, your cost, and what your profit is for each project. And as long as you do that, it gets easier for you, over the coming years because you already have a set record or history of projects. So you know how to bid better, and make profit. So did this evening help you in any way, broaden your thoughts? And I know this is boring. I mean, accounting to let alone to non-accountants, even to accountants, is boring. There's nothing exciting about it. But as long as it helps broaden your understanding, even if you have an accountant, it's better to know yourself, to grasp things even from your accountants, or even tell your accountants what to do.
Do you have a quick way of projecting your overhead?
Yes.
For the year?
If you have financial statements. So yeah, if you have your income statements, if you have accurate income statements, you can do a quick overhead. What is your industry?
Construction.
Oh, okay. So for construction, for estimate costs, like I said earlier, it has to be done from cost of goods to sales. That would give you the percentage. Now, your overhead would be anything, you can go a quick way to know where you stand. You can see your total operating expenses. and you divide that by your total job income, that would give you your percentage. So you know that is that much is going to be overhead for you. All your operating expenses is overhead.
That's indirect cost though, right?
So your indirect costs, you have your workers' comp, you have your project managers that is not directly working with the project. So that's our indirect costs to you. So you have your, so the direct cost is you wanted to make sure someone, it is related to that project, whether it's labor or material or anything that has to be directly related to that project. That cost is to that. So then you have to know, like you said, your indirect cost that you have. So those are overhead basically for that project. So you're going to need project manager, right? But that project manager, it has nothing to do with, I mean, he's managing the project, but he's not directly working on that project. So he is indirect. So that's your indirect cost. If you have, like I said, insurance for workers, you can include that as an indirect expenses. What else was I thinking? So anyone who works on the projects but not directly working on the project, those are indirect. But then you have, like I said, your operating expenses, your rent, your office work, office salary. Thus, they don't do any, project jobs. So those are additional expenses. So if you know that percentage and you have already your direct and indirect project costs and plus your operating, then you would know quickly if you're going to make money or not.
So how is that applied then? You project that for the year or look back at history and then apply it to each job as you're going forward? And generally, if that revenue is going to fluctuate by any amount, that percentage could be off by plus or minus amount.
That is correct. So, so yeah, you can project that. Yeah, you should have an actually like a budget for the upcoming year. So that's why history helps you. So if you been in business like 2-3 years, you know how you did in the prior years, and then you can estimate what to expect. So on your and that helps you also to see ahead how you're going to be doing. So from prior year, if you have your records, you keep, and if you expect to increase your revenue, you increase that. If you're going to hire more people, you include that in your budget. So you can see the whole picture actually for 2022. Now, by the end of 2021, you should project 2022 based on your history. So, so did you ask how do you do that, or what was your question?
Yeah, I think you included all of that in there. But to be clear, the office overhead, is that included with the indirect costs to get your overhead cost, or are you excluding indirect cost in that overhead?
So yeah, so indirect cost can be related to your project, but you cannot include it on your estimated cost for the project. You know what I'm saying? So exclude the indirect cost.
So the indirect cost becomes a part of the overhead, which is spread out over many projects rather than just one.
Exactly. But you're directly that, estimating an actual cost that you wanted to track are those related directly to those projects.
Okay.
The others are overhead. Yeah, kind of complicated. I don't think I clear your mind.
Yeah, that's good.
Okay.
I have another question.
Sure.
Yeah, for QuickBooks Online, Right now we're using QuickBooks Online, but it doesn't give you option to track like the hours for like, an employee. Let's say you have direct costs related to the project, and then you have some other costs which are unbillable. So you have overhead. So like for the wages, you can only apply the wage of an employee to one class. So, and then I'm wondering, like, if you want to track all your hours, some of them which goes to the direct labor and the others so that they go to unbillable hours. So I'm not able to do that. I don't know if you have any suggestion how one can track that.
Okay, so I would use, if using QuickBooks, I would use QuickBooks for construction. The online one, I don't think they have all the tools that you need. So if you have QuickBooks for construction, it would have all those the ledgers, and then you will have all different buckets for your estimates, how to enter. Yeah, like I said, if you doing your hours on your QuickBooks, it would give you that option that would flow to the projects. So I would use, you can use desktop if you're gonna subscribe monthly. I would use QuickBooks for construction.
Okay, so that would allow to divide, the direct labor and unbillable hours, and for each employee, you can divide them and even the project. Yes.
Yes, and are you doing it yourself? You wanted someone who understands the system and who understands accounting also. So once it's messed up, it's hard, and it can mislead you. So yeah, have someone who can help you in accounting section. You're expert.
On the software, so you mentioned QuickBooks for construction. I think you mentioned, is it the other one? How many software are out there which one do you suggest for, a medium construction company? Which choices do we have?
Yeah, you can use QuickBooks. It's very friendly and affordable. That's I think the cheapest software you can find.
Which other are there? I know like there is like Sage and the other. Just give us the other.
There's Sage. Yeah, there's Sage as well. I feel, and I have used Sage for different software, different Sage products, but I think QuickBooks is simplified, and it's easy to go back. I mean, the system is made very simple, so anyone can use it. You know what I'm saying? It's not complicated software. So yeah, I think for that level, I would use, unless you are very large, like I said, then like there is other softwares like Foundation is the most I like actually.
Okay, thank you.
Yeah, you're welcome. Any other questions or clarifications?
We have any questions in the future? Is there an email? I'll ask Hebrew that we can send an email question to you. You are very helpful, and we just really appreciate it.
Of course, thank you, appreciate that. I hope so. Like I said, it's not easy for non-accountants. Even for accountants, it's complicated. Construction is not easy. Just like manufacturing, I came from a manufacturing, industries for so many years, but yeah, construction is not for everyone. It's very, very complicated, especially in a system. If something is entered wrong, it would mislead your financials. So,
well, you've done a good job. Appreciate it.
Thank you for joining us.
As for the homework questions that's on the screen now, for everyone, this is due for your next to be turned into me, email to me, Beth Varner. You have my email address because I send you guys always the announcement. Homework question number 1 says, how would carefully tracking your contracts and job costs help your financial statements accuracy? Number 2, how would your company benefit from cash basis method for income tax? And number 3, how would keeping records of job cost estimates and actuals help you with your future bids for projects? You can send your questions and answers, email that to me, please. And the next slide. Next.
If you have any questions at all, you can feel free to email me, call me.
At Ms. BIRIKTY WELDESUS, accountant, president. And any more, do you have any more questions? We answer those during the session at the end. A lot of people have already asked questions. And any more additional questions? Well, the instructions for our next session is we have the complete the survey. We have a link right here. And also I will email it to you guys. I would like for the outstanding people, if they were, send me your photos, because we need that for the session. We have a program booklet that we will be sending each of you guys. So we need the photos for that. And I don't want to call everybody, a few people out that has not sent it to me. And please follow up with me to schedule your one-on-one bonded session with AC Surety. And the next slide, our next session is on March the 11th. The module will be estimating and bidding by Lee Thomas and Lewis Parkins from the Project Cost Solution. Next slide. I want to make sure I emphasize our upcoming Nashville MSA procurement webinar on March the 16th. Registration is open. I also email you the flyer. I attached it in the email with the reminder for the class tonight. And so far we have the invited agencies, the Tennessee's Department of Transportation, Nashville Metropolitan Transportation Authority, WeGo Public Transit, Metropolitan Government of Nashville and the Davidson County, and the BNA Nashville International Airport. There's $1 million opportunities will be made available. The registration is open now. The link is on the email that I sent you. It is. Now we'll send the flyer out again so that you can click on the link on Eventbrite and just go directly to registering yourself for this great session on Nashville Metropolitan Service Area procurement webinar.
Ms. Beth, go back to there's a question going back to the page at the end.
Pardon me?
There's a question that's asking to go back to the page at the end by
please go back to the question page at the end.
For some reason, yeah. What was the question regarding this
maybe
page?
that's what they're talking about.
Ms. Necker.
One more back. Is that?
Yeah, it was a question by one of the class participants. Miss Nike. I hope I said her name right. What was your question, please, ma'am?
I just wanted to make sure I capture the questions. Thank you.
Oh, the homework. Ms. Nikki?
Yes, the
Thank you,
homework.
Thurl. Thank you so much. We'll get it to you as
Okay.
well.
There it is right there.
Okay, thank you.
You're more than welcome. Thank you for being here.
Yeah, thank you.
Thanks for an amazing job.
Thank you. Thank you,
so much,
everyone.
guys. Give her a hand, a clap, or something.
Thank you. No,
Put it
thank
out. I
you.
know this is one of them topics you love to do, but it's necessary. And I apologize. I'm not had it. I'm just a little under the weather today, but I'm with you. Just wondering.
Okay.
So
Yeah,
thank
thank
you
you,
all
everyone,
for
for
staying in there too, and just continue to stay with it. It's very, very beneficial to you, and we're excited about the opportunity to serve you. So you guys have a blessed
Great
evening.
session. Great session. Thank you.
Thank you. Thank you, everyone. I appreciate you
Thank
taking the
you.
time. Thank you.
A lot of
Thank
great
you.
information.
Very valuable.
Thank you. Thank you. Thank you for your
Thank you,
time.
everyone.
Thank you. Appreciate you.
Everybody stay safe. And please email me with any questions, any requests, and if you need any assistance.